Alright guys, so in this video it's going to be a recap of ICT's last lecture on the 2025 mentorship. Now, I posted a video on this recently and a lot of people are saying that I've marked out the range wrong, which is true, right? So the last video that I made, just like a lot of the videos that I make on ICT concepts, they are my applications of these concepts, and some things are going to remain exactly the same and other things are going to be adapted slightly just to adapt to my style. What I've found has worked for me is I like to learn the concept and then take what I think could be relevant for my own trading. But in today's video, we're going to actually apply it directly based on what ICT said, just so you can see that anything really works and it works. And I want to illustrate this point. I'll make a video on this a bit later, but looking at the charts here, in the previous video, I marked out the midnight opening range as the opening price at 12 o'clock and the closing price at 12:30, which was, somewhere down here. And with that range, what I did is I pulled a Fibonacci in the range, and you can see how inside that range, price actually respects those key levels. That in itself is something that I've actually discovered from watching ICT's video and his lecture. So first thing I did was I watched his lecture and then I said to myself, wait a second, what if I got the opening price and then the closing price, and then I saw if price actually respected the key quadrants, and it actually did. And when you do this days and days and days and you actually backtest this, it does start to respect those levels. Now ICT, when he talks about the opening range, he marks out a few important key points. The first one that I've got here, this is midnight opening price, right? Midnight opening price. So I've marked out the midnight opening price. What he does then is he marks out with two vertical lines and he goes, okay, where is 12:30? And 12:30 sits somewhere down here. And where is 12 o'clock? 12 o'clock sits here. And what he actually does is he grabs the high and the low of that range. And I'll actually mark the high and the low of that range with this blue line and then with this red line. So that's what he does. With that range, he then looks for any PD arrays that actually stand out. And in this case, you can see that there's this massive bearish gap right here. So he draws that across, and then with that gap, he actually pulls a Fibonacci on that gap, and he watches how price reacts and respects in that area. Now, does this work? Yes. Can the opening range that I marked out in the previous video work? Yes. Any concept can work as long as you collect enough data on that and make it your own. So for example, I'll give you a key thing. The concept of optimal trade entry or the concept of macros, there's going to be so many different ways that people apply those concepts, but they can still be profitable. So for me, I like to apply them in my own spin, and this is how ICT directly has done it. Now with that, he also uses standard deviations, and pretty much what he does is with that opening range from the highest high and the lowest low during that time period from 12 o'clock to 12:30, he then grabs a Fibonacci and he does extensions. So if I was to zoom out here, he then projects up, 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 and then down, down, down. And what he uses this for is to predict the daily high or the daily low, but you can also use this to predict where price may want to go. So on the screen here, guys, I've got the Fibonacci settings, and I've got 0, 1, negative 0.5, and I've got 1 as well, negative 1. These are going to actually allow you to get projections on your screen similar to this, right? So if I just zoom out here, you can see how that gets projected. Now, what you could do is you could use these projections as places where you could take profit. So for example, you could project halfway of this range up if you're looking for longs, and that could be a profit level. You could project one standard deviation up in this case, and in this case, it actually predicts the high of the day here, which is fair enough. So if you extend across this standard deviation level here, you can see how we actually respect that area. Now, moving into the New York session, if you like to trade that, you could then use what's happened in the London session to then apply that to the New York session. So this is that one projection standard deviation. And then you can pair this again, put your own spin to it, assess the concepts, put your own narrative to it. But you can see here that this is when we start to approach the New York session. 9:30 opens roughly about here. And if I was to mark out the macro, and I like macros, so I'm going to mark out the macro from 9:50 to 10:10. Now, there's two ways to see this, and this is a really important thing to keep in mind. So if you're still learning and you're still new, anything can work when it works. Any concept can work when it works. Any application can work when it works, but you have to collect your own data to see how often it works, and when it doesn't. That's really, really important. Now, could we say that this high has been formed and every single day it's going to react from this standard deviation level? No. However, in this case, it does. If you didn't know about standard deviations, and before we posted about this video, I didn't really project the opening range like that. I would personally just be using macros. And one of the ways I like to trade macros to keep it nice and simple is a macro can reverse. It's as simple as that. So if you see reversal patterns around a macro and it pairs with your bias or your narrative, if you want to call it that, it's a trade willing to be taken. And in this case, without that standard deviation, we could still look for a trade because it's a macro and because we anticipate a macro to reverse or to pivot. So if we then mark out this then becomes a really nice inversion fair value gap entry. Stop can go above this order block or above the high, and you can see how price begins to spool during the macro. But this is just to illustrate the fact that anything can work when it works. So that's the opening range there, from this high to this low. That's the midnight opening price, and we can see how price refers to that midnight opening price a few times over here, right? So we tap it here, we tap it here. But ultimately, what I did in my previous video is I actually went from the opening price at 12 o'clock to the closing price at 12:30. So I'm going to mark that out here just so you can see what that looks like. So there's the range that I marked out. These two dotted lines, that's the range that I marked out. ICT marks out this range, the high and the low, always important. And then inside that range, I'm looking for PD arrays that might be respected or disrespected. So there's this massive bearish gap. We can also talk about this bullish gap sitting in the range right here, right? Because what I'm trying to see is when price opens at 12 o'clock, right? And then when price closes at 12:30, this is my interpretation. If the range high and the range low are going to be from 12 to 12:30, it is interesting for me to know where the price opens and where the price closes, because that obviously is where we start and also where we finish. So where we start and where we finish, yes, we're going to have an extreme high, yes, we're going to have an extreme low, but also what's in between that is quite important too. So that's a really important concept to keep in mind. And this is just one illustration. So in this video, we're going to go through quite a few days and we're going to see how often it works, how often it doesn't, applying these standard deviation tools. And one other thing too that I think is really important, and he does mention this too, I didn't talk about this in the previous video, but a lot of people have been asking me about, what about 330? Because he talks about 330 being, really sweet spot in price. Well, in this example, and this is from Tuesday, if I was to mark out 330 with a vertical line, you'll see, yes, on this particular day, 330, right, this vertical line, 330 starts to spool. Is that the only opportunity though in the market? No. But if you want to, apply that concept and use that concept, we can see that roughly at about 330, we actually react from that big bearish gap that we drew out before, this one here. We're inside of that opening range, we're roughly, in that top portion. And what you could do is this, right? So if you actually mark out the high and the low of the range, let me just get rid of this. So the blue and then the red. Then you can grab a Fibonacci and you can actually pull that on this range, right? So it's a little bit different to what I did in the last video, but the concept is still very, very similar. It's still a similar principle. So you can pull a fib on that range. You can go 0.75 level. You can also add on, the 0.25 here. And you can add on the halfway point like this. And then you can look for yourself to see, okay, how do we react and do we respect these certain areas? And again, you can see we do. So that's another way to apply the range and to break it into segments. You can use a range, break it into quadrants. You can use a fair value gap, break it into quadrants. You can use a range and then extend that up and then down for profit targets to see maybe how far it might extend, the 0.5, the 1 level. There's all little things that you can do to actually apply these concepts. But the previous video for me was just my spin on these concepts and something that I thought was interesting taking forward. And it still works, right? It still works. Moving on to, say, the next day. Let's move on here to Wednesday, right? And what I've done here, same kind of principle, guys. I've marked out this zone here. So I've marked out with this line 12 o'clock open, and I've marked out here the 12:30 price closing, right? I've marked out the lowest low and the highest high within that range. That's exactly what ICT does. And then inside that range, I've marked out this fair value gap here. It just stands out, right? It's one that stands out. And then if we extend that across in time, we can see how price refers to that again right here. And I'll talk about this in my previous video. I'll talk about that fair value gap and how you can pair this with a macro and you can pair this with time to then, adapt these concepts to maybe what I teach on this channel, which mainly is macros, inversion, fair value gaps, time, and also price. So it's just to illustrate here that a lot of concepts can work. And if you learn a concept from ICT or if you learn a concept from me and then you put your own spin onto that concept, that's completely fine, right? That's probably a good thing, right? Because then you're starting to see patterns repeat for yourself that maybe you can build models on, your personal models. So all my personal models that I teach in my Discord, they are applications of what ICT is taught. So ICT is taught the basics of OTE, Power 3, macros, and then I've combined different elements. I've seen things that repeat, and then I've put those into actual, models and concepts that we can apply in the market. So that's quite interesting there. And then again, we can do the same thing. So if that's the range, the highest high and then the lowest low, we can then mark out the standard deviation projections, and we can grab our Fibonacci, go from the high of the range, we can just do it from here, to the low of the range, and we can mark that out, right, in time, like this. And you'll still see the same thing, like you'll still see, even if we project it exactly like ICT does, we can still see how price reacts from these key levels. That's completely fine. We could also project this using standard deviations. Get rid of this, get rid of this, get rid of this, change this to negative 0.5, and then we can change it to -1. And in this case, I'm going to project down, right? We can project down. We could also project up. All we have to do to project up is we just draw the Fibonacci in a different way. So if we draw from the high to the low, you can see that the projection goes down, right? The 0.5 and the 1. If we go from the low to the high, the projection will go up. So if we just go like this, from the low to the high, the projection will go up. Now, in this case, we can project a little bit further. So let's actually project more numbers. We've got the -0.5, right? We've got the -1. Let's go further. Let's go -1.5. And let's also go -2. And let's just keep going into these standard deviation projections, because 2 to 2.5 can often be a nice little zone to watch price react from. So let's just do this. And let's see if price reacts from any of these key areas. So that's what we're looking at here, right? Now, if we extend that, we can see that price doesn't really come up into, if I zoom out, doesn't really come up into the -2 to 2.5, but ultimately, it stops probably roughly around this standard deviation level here, right? And then it starts to sell off. But again, do you have to just use standard deviations as, okay, this is going to work every day? No, because yesterday, what did we see? Yesterday, in that example, it was pitch perfect, and at the -1 standard deviation, we saw that price form the high of the day and then price reversed. In this situation, do we get some kind of pullback from -1? We do. So if we look here, we do get some kind of pullback from -1. We do get some kind of pullback from 1.5. We do get some kind of pullback from in between, right? But it's not always going to work. And that's a really important thing to keep in mind. Every single day, the context is going to be potentially different. And then even looking now into yesterday's price action, let's do exactly the same thing, and we'll see how this opening range plays out. So again, we've got this is the opening range, and I'll zoom in a little bit further here. So if I mark out the 12 o'clock price, that's with this line, 12.30 is here. So I've gone for the lowest low and now the highest high. This is what ICT exactly does. This here is 12 o'clock opening price right there. So that's the black line here. And you can see we kind of trade inside that range quite a bit. So if I then move that across now, inside of this opening range, this fair value gap is quite large, right? So if we apply that concept of, looking for fair value gaps that price, respects, or that are quite big in segments, we can see that this fair value gap is quite large. Now we could extend that across in time. We see we refer to that a few times. If I zoom across, a little tap here, a little tap there. But ultimately, this range is a little bit different, right? So because obviously the markets maybe shut a little bit earlier, the range doesn't present as far as it normally would, leading into the New York session. And what you can see here is we could do the same thing with projecting the standard deviation tool. So we could grab our Fibonacci and we could go, for example, from the low to the high, and we can project up. But we don't move up. Price doesn't move up, right? Price doesn't move up. We could also project this tool to the downside. Right, so we could go like this and project to the downside. So once that opening range is done, we can project to the downside. Now in this case, what's interesting, which we can apply here, is price roughly stops at around the 2 to 2.5, roughly give or take. But that's not the be all and end all. And I want to get into this a little bit further because, again, a lot of people had concerns in my last video about, you're not drawing the range right, how is anyone going to be profitable? All these little comments and things, right? But it's important to understand if you're still learning, but have a look at this 2 to 2.5 range, and I've drawn it out exactly how ICT is drawn out, the highest high and the lowest low. You might say to yourself, okay, price has reacted from the 2 to 2.5, beautiful. In this particular day, or on this particular day in my Discord, I didn't even need to use the opening range or the standard deviation projections, and I still had an inkling that price would actually reverse from this point. And let me show you how. And this is why I say that anything can work when it works. So ICT's got his strict way, and that's completely fine. It works. I might have my, adaptations from ICT's concept and it works. You might have your adaptations and they work. I know people that are in my Discord, for example, and they trade ICT and support and resistance together and they're highly profitable. So, completely different analogies here, support, resistance, ICT, but it's still profitable. Now, if that's the opening range, let me kind of show you as well what else actually governs price reacting from here. Now, remember at the start of this video, I mentioned that macros can also reverse. Look at this macro down here. So 250 to 310. Do you need to know about the opening range and standard deviation projections? Maybe you find it a little bit too hard or confusing. Do you need to know that to build a profitable model? No. On this particular day here with my Discord, I was waiting for price to come back down into a 15-minute fair value gap and into optimal trade entry of the previous range. So if then we go to a higher time frame and then we go to say a 15-minute chart, right? And this will open your eyes hopefully, right? But if we go to a 15-minute chart here, we can see a dealing range. And this is something I explained in my Discord. We've got a low there that's been swept and we've got a high here that's been swept. Notice that. So we've swept buy side, we've swept sell side. So between this swing low and this swing high, that is a dealing range. And that is where we can pull a Fibonacci on. So we go from the swing low to the swing high. Now we need to change our Fibonacci settings. So we'll go into the settings here and we'll get rid of all these. And we're gonna say 0.618. And then we're gonna also say 0.786. So those are gonna be the Fibonacci settings for optimal trade entry. And then with that range, let's actually pull that across like this. Just like that with a red box. Notice how price reacts not only from the 2 to 2.5 standard deviation of the opening range, the midnight opening range, but also from optimal trade entry. Up to you how you apply the concepts, up to you which concepts you take forward, because in this situation here, to understand that price might actually retrace from this direct area. Do you have to know about standard deviations? No, but can you? Yes. Do you have to know about optimal trade entry? No, but can you? Yes. Do you have to know about macros? No, but can you? Yes. And I suppose the best thing to say to conclude this video would be combine the concepts that you want to combine to actually, become profitable and to study in the market. Even in this situation here, right? ICT mentions that 330 is going to be where price, does something important. 330, guys, is all the way up here. The move's already happened. So in this situation, 330 did not spool. If we go back maybe to the previous day here, let's have a look at 330, right? So we've drawn the projections here. 330, we can see price begins to move from 330, beautiful. But where do we pivot a little bit before? So maybe we can use then 330, or you could, forward test this would be a good idea. Forward test the idea of if the market moves prior to 330, 330 may give you that second push, right? So the market has moved prior to 330, 330 gives the second push. If we go back to the previous day, obviously we saw that, 330 did give the push, which was right here somewhere. Let's go back to a further day here, and let's have a look for 330 in the markets. So 330 is roughly about here. We can see we moved up prior, but maybe 330-ish gives you that second push. Go back to maybe a previous day. I want to see as many examples as possible, and this is what you should be doing too, to collect data on these models. So let's go back here and let's have a look at 330. So 330 here, we kind of stall, and then it's roughly at about 350. So maybe you could apply a model on that, just like I've done with macros and recognizing patterns with macros and so on and so forth. I guarantee you, if you study the 330 time frame and then you study price action before and then price action after, you'd probably be able to come up with a model too. So anything works and it works. I hope this video has been insightful. I know a lot of people have been asking me, and both privately and also on YouTube, about the previous video about being slightly different. But again, these videos are just my interpretation, and I'm taking information and making it my own, so that way I can apply that in the markets for myself. Again, I appreciate all the support. Hopefully this has been insightful, and I'll talk to you guys in the next video. So next time he releases a video for his mentorship, I'll have two parts of the video. I'm going to have directly strict what he's saying, and then I'm also going to have my interpretation and my application. So I hope that helps, guys. Anyway, peace out. Talk soon.